Bubbles and recessions. It's the two words everyone in finance fears. Since the Great Recession of 2008, the United States has been largely immune from these economic downturns. Outside of the massive drawdown we saw in March of 2020 due to a black swan pandemic, the US stock market has enjoyed a golden era of unbelievable returns with little to no drawdowns. Since August of 2010, the S&P 500 has had a return of 487%. Those who had the luck or skill or insight to invest during this golden boom have seen their portfolios grow well past anyone's wildest expectations. Today, however, a paradigm shift is occurring as we speak. Trouble in paradise that is making a lot of experts panic. Something bizarre is happening behind the scenes, causing a ripple effect of worry that isn't captured by the obvious charts or headlines. If we just examine the last 10 years of the market, we can see that investors have had little to no worries. Every single drawdown became a massive opportunity. Buying the dip was extremely profitable, and dips were rare and short. Since 2010, the market has only fallen below a post-recovery high once during 2022 when it dropped 25% and took 2 full years to recover. That decline was driven by the Fed hiking rates 11 times into a weakening economy with inflation surging. Yet not even a pandemic, 10% inflation, and the fastest rate hike cycle in history could derail the market for long. By 2024, we were back at all-time highs, pushing past every previous barrier as if those setbacks were just speed bumps. So given these facts, why is anyone worried about a recession or bubble given this extremely frothy environment? The answer lies in two places: the macro fundamentals and the hidden forward indicators. So let's start with the macros. How does anyone really know we're in a bubble? The truth is, there is no simple answer, but there are signs that people ignore, whether out of greed or pure delusion. One of the clearest measures is brutally straightforward. Take the total productivity of a nation and weigh it against the combined value of every stock traded within it. That's the Buffett Indicator. And unlike most flashy metrics, this one has over 50 years of hard data to define what normal should look like. It tells us how much more or less the US stock market is worth compared to the nation's GDP. The most reliable version of this measurement uses the Wilshire 5000, which is a market index of nearly every publicly traded stock in the US, and puts it against US GDP. And today, that figure sits at 210%, the highest in history. More than double the levels of 2007 and the peak of the dot-com bubble in 2000. So the question is, could this somehow be normal? Are we living in a new age where the data screams bubble, yet the economy has quietly shifted into an era we don't fully understand? There's plenty of very sophisticated answers to those questions, but ultimately the proof for me lies in the supporting metrics. Even if you dismiss this data as unreliable in the modern world, you can still see overwhelming evidence of a bubble by looking at something like the Shiller ratio, also known as the CAPE ratio. This thing is basically Wall Street's BS filter. It smooths out a decade of earnings to reveal if stocks are truly cheap or dangerously overpriced. It basically begs the question, what are stocks really worth compared to the long-term power of corporate America? Now, I won't get into the technical aspects of how this works, but just understand this. It takes a decade of corporate profits, smooths them out, adjusts for inflation, and stacks that against today's stock prices. In plain English, it strips out the noise and tells you whether the market is truly cheap or dangerously overpriced. For the CAPE, we have data going back 154 years all the way to 1871. Today, this measurement sits at 38.6, the second highest point in history, only surpassed by the 2000 bubble when it hit 44. So this 1-2 punch of the Buffett Indicator and the CAPE ratio both pointing to severe overvaluation is hard to argue against. Anyone claiming this isn't a bubble is going up against serious evidence to the contrary. The CAPE ratio alone rests on a 150-year average. To dismiss that is to dismiss more than a century and a half of market history. Even if you believe markets have somehow changed and old averages no longer apply, it's still hard to argue that valuations sitting over 200% above the long-term mean are in any way normal. That's why so many believe a crash is inevitable, that just as in 2000, the ratio will be forced back down and the path won't be gentle. It will come through a market collapse that drags valuations back towards their historical baseline. Now that's the macro story, but is there really any evidence that we are on the way down? Even if you believe the bubble is here, what evidence do we have that it's imploding anytime soon? Well, this is where the forward indicators come in. You might say to yourself, well, GDP seems to be fine and every company is killing earnings, so there's nothing to worry about. Well, it's actually a lot more complex than that. Under the surface, there are some flashing warning signs that things are not as rosy as the market is predicting. Take, for example, freight. It's an all-out recession in that sector. If you look at a company like UPS or FedEx, the signal is there. UPS stock, for example, is down 62% from its recent peak in 2022. FedEx down 36% from its most recent peak, and the S&P index related to logistics is down 43%. That's a clear sign that fewer goods are moving, which usually means demand is softening both on the consumer and industrial side. You would think that in a market that is healthy and hitting all-time highs, the very mechanisms used to move goods around the world would be booming, but they are faltering as we speak in this dark corner in the market. Back in April, Apollo Global Management released a report they titled The Voluntary Trade Reset Slowdown, their blueprint for how a recession would unfold. At the center of this was Liberation Day, April 2nd, the very day Trump's tariffs took effect. From that moment, Apollo warned the clock was ticking. They predicted the first signs of a slowdown would hit the American ports by May. That call didn't pan out at first as the president kept announcing deadline extensions, which led companies to front-load imports. The result? Record-breaking import volumes in July. But as officials noted earlier this month, the peak season now looks finished. The first few weeks in August have already shown a sharp drop in traffic as companies work through that front-loaded inventory. Apollo also predicted trucking would slow down by May, and that part has been spot on. While mainstream media barely covers it, the trucking market is in a recession right now. Even back in April, Craig Fuller of FreightWaves was warning that volumes were dipping below COVID levels and that the trucking market was on the verge of collapse. This trend has continued into the summer, showcasing that the goods economy is really struggling. Trucking has been teetering on the edge for months now. Apollo's next warning was blunt. Trucking companies would start going bankrupt, and it didn't take long. One after another, carriers began folding, quietly swept under the rug, but undeniable. We're not at empty shelves yet, but we're deep into the stage where the backbone of supply chains, trucking, is cracking. Volumes are collapsing, bankruptcies are piling up, and the ripple effects are starting to hit retail. Look at Target. The stock is down 61% from its peak and 28% just this year. How does that square with a so-called booming economy at record stock market highs? It doesn't. The disconnect is glaring, and it's not just Target. Adidas is down 18% this year. Under Armour down 36%. Across the board, retailers are limping along, barely scraping by with weak earnings. Even worse, those beats they brag about are off already lowered bars, guidance set during the harshest tariff pressure. In other words, expectations were rock bottom to begin with. Now that tariffs have eased, the goalposts have shifted higher, and meeting those expectations in the months ahead will be brutally difficult. So when you put it all together, the picture is clear. Leading indicators are flashing weakness as we head into the winter of 2025, while the stock market sits at one of the most overinflated points in history. Both the CAPE ratio and the Buffett Indicator are screaming bubble, and the disconnect between Wall Street's highs and Main Street's struggles has never been wider. This isn't just noise, it's the setup for potential disaster. The next few months could decide whether the cracks stay hidden or whether the whole thing finally breaks. Thank you guys for watching. If you got value from this breakdown, please hit that like and subscribe button and let me know in the comments below if you think the economy and the market can keep defying gravity or is the fall already baked in.